Good afternoon, everyone. So thank you for making the time. I know we're in the graveyard session, and there's a lot more people outside than there are in, but let's hope that we have a interesting discussion today. So the topic that we are here to focus on is resilient returns, and I think the emphasis is on resilient within the African context. But more so, what I really want us to also focus on is the strategies around investing in Africa's climate future. So with that, my panelists here come with a very wide breadth of backgrounds and deep experience in their respective fields. They all represent investors, and we have one that I like to refer to as a catalyst, and I'll come to that as well a little later, both on the debt and equity side, across large and small-scale investments strategies. Thank you for the introduction to myself. One of the things that I would like to say is that I've actually managed to take a business from startup, turnaround, as well as into exit, and we had 2 successful exits on that business within Pan-Africa. So we were able to provide resilient returns, and hopefully I'm evidence that it can happen. It may take sometimes a bit longer than anticipated, but it does actually happen. So with that, let me introduce my panelists. I'm going to start with Susie. Susie is the Chief Investment Officer of Empower New Energy. And then we have Ziad. Ziad is the Chief Investment Officer of Rovigo. We have Wale, who is the Global Director of Government Enablement with GIAP, and we'll allow for him to actually tell us a bit more about that. Peter, who is the Partner and Investment Director of the Spark Plus Africa Fund, and last but not least, Pranav, who is the Portfolio Manager at GemCorp Capital. I want to actually start with GIAP in the room. There's been many announcements being made as part of Climate Week around GIAP and what they're doing. And Wale, I think, why don't you start with a short overview of GIAP, what you're doing in Africa. Do you act as both equity provider and debt? I've also seen you on the fund-of-funds side. And what is that catalytic focus of GIAP, and how are you assessed from a returns perspective?
And thanks, Jacinda. Thank you to the organizers as well for giving us a platform here to speak. GIAP, which is short for the Global Energy Alliance for People and Planet. And yes, it's a ridiculously long name. But it is essentially a public charity set up by 3 of the largest philanthropies in the world, the Rockefeller Foundation, the Bezos Earth Fund, and the Care Foundation, about almost 3 years ago now. And they set up GIAP to help drive and accelerate the journey towards the achievement of SDG 7, energy poverty, reducing energy poverty, providing universal energy access, and doing it in a decarbonized way, so primarily through renewables. To answer your question, Sandra, we're kind of like all of the above. So we try to invest largely the money we get from our philanthropic founders across the ecosystem where we see gaps exist towards accelerating and getting towards this SDG 7 goals that I was talking about. And sometimes, very often, that means working on projects directly or through platforms, investing in those projects in a catalytic way. And we do use debt, equity, but we're also actually, because we philanthropic funded, we don't actually seek a return, so we use grants quite a lot. Sometimes they're returnable grants, so basically zero interest debts. But in addition to the way we see, being a catalyst goes beyond investing directly into projects or into project via platforms. We also try to work around projects and help enable them to work. Sometimes supporting projects directly through some of the, supporting technical assistance, for example, and capacity building. But sometimes actually also at the ecosystem level, working with government, and this is probably my role in thinking through ways in which we can not only get specific projects that we might or our partners are funding to work, but having much more projects work at the scale required for SDG 7. I hope that answers the question.
Great. Thank you. I think that's helpful as we go into this discussion. But I'd like for each of the panelists to perhaps give us a short overview of their businesses so that the audience can better understand what you're doing in those respective businesses. We do have a broad array of focus areas here, and how then are you actually producing resilient returns? Start with Susie, yeah, great.
Good afternoon, everybody. So I'm Susie from Empower New Energy. Empower New Energy was established in 2017 because we saw a gap in the market in that there wasn't really the investment being made in the commercial industrial sector. We invest in solar with or without storage for industrials and agricultural businesses operating across many different countries in Africa. So you've got the sub-Saharan band from Nigeria, Ghana, down to Zambia, along to Kenya, and then in North Africa as well, Morocco, Tunisia, Egypt. What we realize is to establish a company to invest in CNR, you have to think out of the box and be very resilient. And the way we've structured our business is in a very resilient manner. I think there's three R's really in the resilience there. You know, the way the money comes in for our investors has to be looked at from a resilient approach perspective. We've deconstructed the way in which one would ordinarily do business and invest. We've streamlined our operations. We still do due diligence to a really high international standard, but we minimize the costs. We use platforms to bring our information together. We've got standardized contracts, it was mentioned in the previous panel. That's at the core of what we do. And it's also looking at the way the money is going into our projects, into our commercial industrial players. There we're making sure that there's this resilient approach in looking at the credit risk of our off-takers. When you're working in the C&I space, your counterparty can be any type of corporate, and you've got corporates in their different sectors and also the ways in which they are growing as a business. And then we have to look at sort of the risk of that capital. And then finally, you know, being resilient in the way in which we want to get that money out back to our investors. It's a cycle after all, and looking at the repatriation risk. And that's where I think our structure is very unique. It's a platform investment operating across different sectors, different countries, and so we can weather the storm. And sort of when you've got Nigeria mentioned as a sort of difficult jurisdiction in terms of repatriating naira, or converting it into USD and taking it out of country, we can wait and we can look at repatriating in different jurisdictions where it's easier.
Great, thank you. Pranav.
Yep. Nice to meet you all. My name is Pranav Kumar. I'm one of the portfolio managers at Gemcorp Capital. We are perhaps to kind of differentiate us from some of our kind of colleagues on the stage. We're a purely commercial focused investor. We've been operating for about 10 years and have about $1 billion in assets under management. And we actually have a global mandate to invest across emerging markets globally. But funnily enough, at least 2/3 of what we have done over the whole kind of 10 years has been in sub-Saharan Africa. And I should say it's primarily in private credit, but with some very selective private equity as well, among other things. So why is that? I think, and this kind of plays to resilience a bit as well, it's kind of boots on the ground, right? Like we have actually kind of something like 175 colleagues globally, and at least half of them are kind of directly based in some of our host markets, right? And that permanently, right? And that kind of affords us kind of staying power. It makes us kind of really kind of first in line for the kind of opportunities that we like to see. And what those look like, and I think there's kind of, I kind of mentioned we invest across the capital structure. We also across a full range of sectors, including kind of public sector financing through to the full range of from renewable energy through to kind of mining and telecoms. The kind of common thread that runs through all of the investments that we make, I think the first thing is essential needs. And that's best qualified by our colleagues that are based in our host markets. So we have a big office in Luanda in Angola, which is one of our large host markets. We have a portfolio company and a kind of large team based in Nairobi. We've had kind of colleagues in Ghana, in other markets, Ethiopia and Zim over the years as well. So the first thing is kind of essential needs and therefore kind of fundamentally resilient businesses, whether that's contracted cash flows or demand inelastic revenues, like in the telecom sector, for example. The second thing is a focus on hard currency, whether that's by design through kind of the revenue stream or the price and elasticity, and just getting comfort around not just, and kind of your point, Susie, not just kind of resilience to FX shocks, but also the ability to repatriate consistently. And we look at the track record of that by actually taking the time and doing that due diligence. And yeah, look, I mean, the third thing, and it's kind of rare to find those three combined, and I think this is where kind of Africa is really a kind of a special opportunity, is a growth story as well. And what we've really liked about the investments that we've been able to make in sub-Saharan Africa is that there's a combination of kind of resilient, defensive, kind of essential needs, but also a fundamental growth story, thanks to obviously kind of favorable demographics and underlying GDP growth. And look, it served us pretty well over kind of the 10 years. We've had net double-digit returns and no overall down years as well.
Good, great. Ziad.
Hey. Yes, thank you, Jacinda. Hello, everyone, and thank you for the opportunity for me to talk this afternoon. My name is Ziad Sarang. I'm the Chief Investment Officer of Rovigo Fund Managers. We're a South African-based fund manager that has a very different profile and focus in that we are very narrowly focused on investing in renewable energy assets only. And when I say assets, I mean projects directly. The focus is such that we create a deep specialization in renewable energy with a mandate in sub-Saharan Africa. In the short term, we've got a focus in South Africa. We have 10 assets under management currently. The fund took in August 2021 about $87 million. It's valued now at $111 million, and we've returned dividends to shareholders of about $24 million. So what makes us different is that we are permanent capital, or the fund structured as a permanent capital vehicle. We take significant equity stakes in projects alongside developers or IPPs. And why do we do this? Is because we want to develop the secondary market. So we predominantly invest in operating renewable energy assets of utility scale. We've got a significant pipeline of those assets. The one thing that's holding us back, and we'll talk about that, is the attraction of investors into the secondary markets. So we spend most of our time trying to explain to investors how these returns are in fact resilient, and we've got a 3-year track record of showing that. But really there is no secret sauce. It is really hard work to source those assets, find good quality assets where you partner with operators, IPPs, and even exiting private equity, because ultimately we want to create an ecosystem where you can unlock that trapped capital from DFIs, from IPPs, and in South Africa there's a specific category of investors called Black Economic Empowerment shareholders, where they need to unlock their capital from operating assets and go back and redeploy it into development. And we've seen this. I mean, we've got a target annual yield of South African CPI plus 5 to 7%, and we've hit that every year for the last 3 years. So that's about 6-7% in US dollars. We'll go into the challenges later on, but I think that's a good enough introduction.
Great, thank you. Peter.
Great, thank you, Jacinda, and yeah, thanks to the organizers for giving us this opportunity to speak and share a bit about what we do. So I represent Enabling Capital, and more specifically one of its funds, which I co-manage, called Spark Plus Africa Fund. So Enabling Capital is a Swiss impact asset manager. Perhaps on the other end of the spectrum from you, Pranay, we're very impact focused, but our two funds, so there's an open-ended global microfinance fund, about $600 million, and then a very small thematic fund called Spark Plus, which is $64 million. It's a blended capital fund, and it is focused on this topic of clean cooking. And so Spark Plus is, it's a private debt fund. It's backed by a mix of public and private investors, DFIs, family offices, foundations, and we have 4 pension funds. So we've used the sort of power of blending to attract quite commercial investors into what is really an early stage and, relatively speaking, risky endeavor, funding, innovative companies that are addressing the cooking energy issue in markets throughout Africa. Essentially what we're doing is funding companies through various approaches. So within this sort of niche of clean cooking, we have quite a broad set of instruments that we deploy. So we invest on balance sheet. We provide working capital facilities, inventory finance, that sort of thing. We partner with product suppliers and distributors and create sort of tripartite structures that enable them to purchase inventory from their suppliers and have the suppliers put some skin in the game by deferring a share of their margin until the loan is repaid. But we also do a lot of carbon-backed project finance type loans. So off balance sheet, backed by ideally a firm offtake of carbon credits by a creditworthy off-taker, whether that's a corporate in the voluntary market or like an Article 6, and we can talk more about this, but the emerging kind of Paris Agreement mechanisms. So a sovereign buyer like Switzerland that's buying credits from one of our projects in Ghana. So that's really what we do.
Great. As you can see, quite a varied group of investment opportunities are being represented here today, and as a result of that, very different return and risk profiles that come with that. So Pranav, I'm actually going to start with you. Quite recently, you actually acquired a significant minority stake in the Lake Turkana project. Mm-hmm. That has been, for those that do not know it, one of the most transformational projects to be ever devised on the African continent. It is a wind power project. Took 12 years through development, and you came in during operations.
Yep.
And tell us a bit more as to, what was the investment strategy around that,
yep,
and why, as a commercial investor, yes, I do know it does provide a commercial return, but you've come in quite late during the operational phase. Why was that so?
Yeah, no, absolutely. So yeah, that's right. So we acquired through a portfolio company of ours the stake, actually, the vehicle of the original developer of the project in April last year. Look, I kind of to kind of recap on the kind of the common thread kind of running through all of our investments, but I think our investment in Lake Turkana is an excellent kind of case in point from that in that regard. Essential needs, right? It supplies something like kind of 11% of the country's electricity last year. Kind of critical infrastructure for the country, and therefore from that standpoint, resilient kind of revenue base. Hard currency by virtue of the structure of the project, and it's certainly a very well structured project with and look, when we come in as a brownfield investor, we're very much appreciative of the ecosystem that kind of brought it through that 12-year development cycle. And yeah, look, the growth story. So by acquiring the stake that we did, what we're excited about is the opportunity to kind of take it to the next level, right? And we with our team in Nairobi at our holding company level, we have 7 kind of industrial specialists who are working on kind of the feasibility work and the development work of an expansion of capacity at the site. and other optimizations around the project, and then look, other stuff that's strategically adjacent in the region that love to talk about in more detail. So it's got the kind of the growth story there, right, as well as a robust kind of baseline returns. And it's been kind of an operating kind of track record for 5 years now, which is something that we like as a defensive investment.
Great, thank you. So Peter, we hear about very ambitious plans for electrifying Africa. I think last week we had the 300 million by 2030 program being kicked off. Also, if this materializes and we do truly electrify Africa, why is clean cooking a good investment strategy? Is it simply an intermediate play for you? Walk us through the investment methodology around that. And do you think that if we have electrified Africa by 2030, which I'd love to see in my lifetime, walk us through that.
Sure. I mean, clean cooking is many things, right? It is everything from, slightly more energy efficient stoves that use the same fuels that people have traditionally cooked with, wood, charcoal, et cetera, all the way to truly clean, modern cooking solutions like LPG, but ideally like electric or bio-LPG in the future, where it's a non-fossil based fuel. So we recognize that you can't deploy the best of the best in all markets. Mm-hmm. So our strategy is sort of inclusive of all of these different solutions. We are funding rollouts of electric cooking appliances. We're funding companies that are building, increasing their footprint of their LPG distribution network, that are integrating technology into LPG distribution, using pay-as-you-go meters on top of cylinders. We're funding companies that are financing and installing biogas digesters, which have sort of applicability to smallholder farmers. But we recognize that all of this more sort of urban and modern kind of cooking appliances and business models and infrastructure is not going to reach many people in many markets. So we're also funding carbon-backed projects that distribute, cook stoves to people who really wouldn't buy it. I mean, they would not be able to. They would not pay for, because they're collecting fuel wood, which has zero cost. So to sell them an affordable LPG cylinder every once in a while, they still won't buy it. And so we fund different things for different markets, and it's clearly not intermediate in the sense that there's a transition that will occur. Maybe some of the improved cook stoves that will issue carbon credits for the next 5 years. If you look out 10 or 15 years, those will sort of phase out. Mm-hmm. But a lot of the solutions that we're funding and the innovation that we're hopefully enabling some of these companies to undertake will really be long-term.
Great, good. Okay, well, definitely something to bear in mind as I think GAP and that strategy of the M300 actually moves forward. I'm going to come back to you now, Wale. In the previous panel that we were in, we talked about governments and, should we adopt a Pan-African approach, or should we just look at, each of the respective governments? And there was quite a diversified view that came out of that. But I'm very curious from your perspective and the experiences that you've had on the ground, how can African governments create more conducive environments for private sector investment?
Thanks again. That's a really good question. And I think there are there's a really long list of clear things to do, but I think it will be worth reflecting really on the importance of governments broadly to this topic of investment and getting resilient returns. And using Mission 300 that you've just mentioned as an example, thankfully many of us here are looking towards have as an impact electrification, right? And so this initiative, Mission 300, for those who don't know, was announced in the World Bank spring meetings earlier this year by the World Bank and African Development Bank, that they were going to try to connect 300 million people in Africa by 2030, which is basically sort of half of the current energy deficit. There are about 600 million people right now who don't have access to energy. And they were also going to, again, mobilize their resources towards addressing the clean cooking gap. And they were going to do this by committing 30 billion out of the concessional capital that they would normally channel to governments, and try to allocate that towards this electrification effort. But they and governments recognize that 30 billion is not what's going to cost to connect 300 million people. You're going to need more than 3 times that amount by going by experience and the leverages currently that we see in the market between public and private leverage. So that means you need somewhere an additional 60 to 70 billion that has to come from somewhere. So yes, the World Bank is saying we will, through governments, make 30 billion available, but governments themselves needs to make the situation enabling enough for another 70 billion to come in from the private sector, from people like yourselves. And so that goes to the question of, how do governments do that? First of all, I think they need to recognize that there is that gap, and do that at the political level. So there's a certain political will and consciousness that most governments need to come to, and not all of them are really at that point. A lot of governments are still, hesitant to allow the private sector into the space, into electrification space, or many other climate adaptation spaces as well. And so that's sort of like reticence, right? Actually signals, the private sector is never quite sure that they should come all the way in, because they're never sure that the government won't change its mind at some point in future. So it's very important for governments to signal that they understand that to close this gap, you need the private sector. They have to be partners in this. And then I would say the next thing there is planning. A lot of our government partners that we work with don't actually know how much capacity they need where. And they've not really engaged with partners such as ourselves or many private sector partners to know. So even when you have a good project that's coming in from a private sector perspective, how do you know that there's no competing project, or there's not some already government plan there? Because most government planning at that sort of like national level isn't comprehensive enough and isn't integrated enough. And so governments, I would say one of the real things they need to do once they recognize this is to have in place very solid, least cost energy plans at the different levels of sort of like management in many governments, like in Nigeria, for example, where a lot of the power over the electricity sector has been devolved to states. You should have state level plans. And if in countries where it's national, you have national level plans, so that everybody knows where they are. And those plans need to be able to factor in where the money is going to come from. And this goes back to that first point, because in costing your plans and understanding, okay, you need this amount of generation to be able to meet your electrification needs, and you need these kinds of technologies, whether off-grid or off-grid, so you have to sort of like work through a geospatial type plan. Costing that will tell you that when the government looks at its budget, that you do need more, right? And so that's a good reality check, having those plans. But it also helps to signal to the private sector, again, that we know where to invest, we know where to go. And then lastly, I would say building in a lot of the clearer playing field for the private sector to be able to be assured of a return. So it's fine for them to be able to come in, but how are they sure that they can get those resilient returns that were coming in? And traditionally, that's where a lot of focus goes into, in sort of like having good regulations, a good tariff methodology, where move tariffs towards cost reflectiveness, and all of those sort of like movements. Those are really important and those are critical. But it's also the staying power, I think, that the government needs to be able to show to the private sector that we will stick to this. Mm-hmm. We've seen situations where governments agreed to some sort of cost-reflective tariff only to reverse it after a few cycles. And so that's staying power and sticking to the fact that we need to be able to really work with the private sector as long-term partners is something that once government puts that in place, it's a good start to go in. And there are many others I could get to, but in the interest of time, I'll leave those.
You've got a long list of things you're going to have to do when you get based in Africa. Yeah, well, thank you. That was helpful, and you know, I really hope that we can get governments aligned from that perspective. I think it would help in terms of moving the needle faster. Susie, I want to come back to you. You know, we spoke about this in the past. You know, typically, it's been private equity funding that's been going in. It follows a certain kind of structure. You know, 5 years of investment period, 5 years of harvesting, maybe an extension by 2 years. What's your view? What do you think will ultimately work in the African context, and particularly to ensure that resilient return? And is that private equity model the way to go?
So from my perspective, no. And when we established Empower, we looked very carefully at the variety of models available. We did move down the fund structure. We found that very constrictive for what Empower wants to do, which is to invest on a platform basis and to continue scaling up. So to have a set lifespan did not seem to be the right approach. So we've established ourselves as a corporation, and for us that gives us the flexibility to be able to invest and to make those decisions as to how and when to allow for money to go back up to the investors through dividends, or even through refinancing small parts of our portfolio. We can do it on a jurisdictional basis, or we can do it in on a sector basis if we want to, or we could do the whole lot, and we can look at trying to capitalize on our the projects that we have in country and take local currency financing, which does alleviate many of the pressure points in our on our bottom line. Or we can have a look at doing a refi at the parent levels. All that flexibility, because we're not constrained by a fund. So that works for Empower, but our model is obviously slightly different from other models. But I want to just make a point, Wally, you were talking about sort of the regulatory aspect, and then how investors are not really looking at how that money is going to be used in country. And I think I do something very different. I'm looking at CNI, but I think that's really opening out to, we need to know how that money is going to work in the sector and in the context of where it's going. And so not understanding the regulatory framework and not understanding specifically how the local regulations, the government structures might impede the investment, I think it can really be sort of catastrophic. So sort of just sideline, yes, but I thought sure. Wally's point was so really spot on. I really wanted to sort of just re-emphasize that, and it's so pertinent to what Empower is doing.
Great. So Ziad, I know you're a sub-Saharan African fund, but you've been predominantly investing in South Africa, and you've been on the operational asset side. What would it take for you to acquire a stake in a project outside of South Africa?
Thanks, Jacinda. There's so many points I want to address there, but I'm going to answer your the reason why we are in the short term focused in South Africa is because given our mandate and given the market for secondary assets or secondary renewable energy assets, we did a bit of a study. We commissioned it together with Mobilis, and Wood Mackenzie did it for us. And it was very clear to us that 90% of the entire market that fell within our mandate was in South Africa, which left 10% for the rest of Sub-Saharan ex-South Africa. And we're a very small team, 6 people. So it is really, and we're a 3-year-old fund. So it is really very difficult for us to follow individual projects outside of South Africa. Not that we don't, we do. But what will it take for us to do that would be the right ingredients. Most of the deals outside of South Africa are, let's call it sporadic deals, not programmatic, unlike South Africa, where you've got big deals with a programmatic approach. The enabling environment has been created through government's reprogram, and now the CNI investments have been opened up by government. There's no more restrictions in terms of private power. You don't have those ingredients in the rest of Africa. You've got individual projects spaced out. It's very difficult to due diligence, and then ongoing management of those assets. That's the one thing. But coupled with that, you have exits from either developers or private equity that are happening not on a project basis, but they're happening on a portfolio basis. And for us as an investor in projects, we value development pipeline at 0. We don't take that risk. We buy into de-risked assets because we provide dividends every 6 months to our investors. And if we don't get access to that cash flows, most of these exits, except for Lake Turkana, it seems, and we looked at that asset previously. It's a lot more difficult. So in the short term, we're building this base. We've got 10 assets under management. They're all in South Africa at this point. But as the team grows, as we scale up, and this is all about scaling, it's a scale game. As we scale up, we would have more flexibility to look at assets outside of South Africa and maybe even take some partnership view where we don't take the development risk and someone else takes the development risk, and then we would be able to look at assets outside of SA.
Okay, thank you. So a question to all the panelists, and I know we're running up against the clock. If you had a blank page and were asked, be it World Bank, DFC, any of the large investors out there, what would be your 30-second pitch to new investors considering investing in Africa? What would you say?
Starting with me, I think just know your market. Wally's point, you really need to know where your money's going and how to make it work. So understanding the regulatory environment, and if you're going into different jurisdictions, understand them all. They're not going to be the same. I take the view that it's not a pan-Africa. I think we can copy structures that work, but I think individually they're very different jurisdictions and look at them differently. But the biggest bit of advice I would give is that the money coming in from your investor is not going to work on its own. It needs to work very hard in country, and that's where sort of the blended finance options have to be explored. I know it's quite a complicated field. There's lots of different things. You've got grant, you've got credit lines, lots of different things to consider. But without that, you're not going to be able to get your project returns. So you really need to look at it holistically and not expect that money is going to work on its own.
Mm-hmm. So when you talk blended finance, you often hear it's complicated.
Yeah.
It's going to take a while, probably 12 months before I'm actually going to get there. What would you tell blended finance providers what they could do better?
I think it has to be a more joined-up approach. At the moment, it feels very fragmented. So you have to understand your business and what your needs are. So whether you need to get a guarantee to de-risk, or whether you need to get a credit line because you don't have the cash up front, or whether it's a grant because you need to get the IRRs to match. But it's you know what your business needs, but then when you're going into the market, there's a myriad of different providers. You've got big guarantee organizations which work at a different speed from what your business needs, so it just doesn't work. So if all of the blended finance contributors can get together and to have a more holistic approach and one that is joined up, I think it would make our lives so much simpler, and we can do more. We can be so more impactful and more catalytic.
Great, thank you. Note for you.
All right. Anyways, so far we've invested just over $200 million in, has touched like 20 African countries, all in sub-Saharan Africa, but much more deeply in Nigeria, in South Africa, in Ethiopia, in Malawi, and some of what we call must-win markets, and we've learned a lot of key lessons. Out of that 250 million, over 70 million have been what you call catalytic capital, mostly into blended finance structures. And I think what I'll say there in my minute speech is, is that we need to think bigger when it comes to blended finance. I think we've tested enough, we've demonstrated many different ways in which concessional capital can support more private sector capital, and we need to just do this at larger scales. And Mission 300, this big initiative I talked about earlier, is an exciting way to do it. And I'd say, come talk to us, come talk to the World Bank about ways in which we can scale a lot of the small type. A good example in Nigeria, we worked with some of you on a first loss facility for DREs. We want to see how that goes from a 50 million facility to a 1 billion facility. We're under Mission 300. We're actually discussing a 1 billion facility right now with the IFC. That's where we need to move to be able to meet the urgency of the need, which is to connect 300 million people by 2030. So my pitch really is, let's think a lot more scale. And then for the IFCs of this world and for the more us as well, is to be smarter in how we deploy and how we talk to governments to deploy their own public capital, to much better address the gaps, right, that give the private sector the resilient returns they need. So a lot of this 30 billion that is being put aside, most of it traditionally would have just gone into 100% publicly funded projects. There's no need for that. That we could design much better ways, and we are trying to, much better ways to use that money rather into blended finance structures so that it can leverage a lot more than the 2x that we'll traditionally be able to get, but maybe 5x, maybe 10x with private sector capital. And that's something that we're really excited about doing, and we're here to chat about that.
Great.
I think that's an excellent point about scaling, right? And like we've been kind of fortunate enough that through kind of the skin in the game that we've put in through our own capital, we've been able to attract co-investment so that we've been able to execute financings of $7 billion over the last decade. And I think the main lesson to kind of the kind of what would you say in 30 seconds to an investor in Africa is I think start by listening and be patient. And by that I mean that a lot of the potential partners that we work with and where I think we find it more challenging is where there's cookie cutter models kind of imposed, right, because of experience from other jurisdictions or from underlying funders, where it's best approach, and I think how we've learned to approach our kind of transacting model is to start with a blank sheet of paper, right? With the kind of the themes that we have and the focus that we have. Start with a blank sheet of paper, listen to what the underlying needs are, and then build the investment thesis from there.
Thank you.
Do I still have 30 seconds?
Yeah, I think we've got 90 seconds left, so.
Thank you. Okay, here we go. So what I would say is, we're in a niche and we're very focused. What we're trying to do is develop the secondary market. The secondary market provides a huge potential because we talk about the gaps, 30 billion not enough. Primary investment is currently trapped. You've got money in primary investment from DFIs, from IPPs, from developers. You need to do more primary investment, absolutely, but you need to release that capital. So investors need to not ignore the secondary market, particularly DFIs. Institutions need to understand that's the patience have put patient capital. The returns will come. They are there. We are showing it. And listen, like we just said, one of the things that I heard in the previous talk, and it really made me sad, the 600 million number has now gone up, and that tells us that the previous models that we're always following is not working. We have to think differently about investment in infrastructure and particularly renewable energy.
Great. Peter, last.
Thanks. Yeah, I mean, I think the pitch for the segment of the market that we're focused on has to start with the impact, right? If you don't really care about the impact thesis, you probably pick a different sector. Two statistics that are very interesting and kind of baffling are that dirty cooking in developing countries emits as much carbon emissions as the entire global aviation and shipping industries combined. So it's a huge, I mean, it's still only 3% of global emissions, but it's still a huge contributor relative to other, obviously if you take all the cars off the road, great, but that's not, that'll take time. So the impact side of it as well, on the health side, we talk a lot about economic development and prosperity. If you have people dying early because they're cooking in this way, that's obviously a real downer to the economic success of the continent. It affects as many people as malaria. It leads to as many premature deaths as malaria, tuberculosis, and HIV combined as well. So it's a huge impact story. And then from a commercial standpoint, it really all hinges on carbon. Carbon credits are what leads to the viability of most of the business models to deliver clean cooking. The previous session talked about electrification and how challenging that is and the probability of default for those investments. It's also challenging to sell cleaner cooking solutions to the same consumers. But if you are able to capture the carbon revenues that are generated from what can and should be and will be, I believe, high integrity carbon credits. Hasn't been the case necessarily in all cases in the past. A lot of criticism around the methodologies, around, are we over-crediting? Is the sector over-crediting? And all kinds of questions. And as well on demand side, are corporates using carbon offsets as a way of greenwashing and not actually decarbonizing their own operations? So these need to be worked out, but it's hard to envision a world in which the Paris Agreement just falls apart and you don't have both the corporate and the sovereign kind of appetite for offsets of some form. And I think clean cooking is, based on the co-benefits, based on the impacts, a really attractive way to generate these offsets. So that's a big part of the sort of pitch.
Great. Thank you. I think we could have easily needed another 10 to 20, maybe 30 minutes in terms of some of the points we wanted to go into much more detail. But let me take this opportunity to thank you all. I really enjoyed the conversation and the debate, and hopefully our audience did as well. Thank you.
Thank you.